You know, in the world of finance, there's this massive, multi-trillion-dollar practice that can send a stock price to the moon, make executives rich, but according to its critics, it's also gutting companies from the inside out. Today, we're breaking down corporate share repurchases.
So let's start with a really interesting question. What if a company's biggest buyer was itself? I mean, what happens when a company just decides to become its own biggest fan, using its own cash to buy its own stock? That's a share buyback. And believe me, this one move has totally rewritten the rules of the game on Wall Street.
Okay, so how does this actually work? Well, it's surprisingly simple. A company takes a chunk of its cash, goes out into the open market, and just buys its own shares. Those shares then basically vanish. They're taken out of circulation. The total number of shares out there shrinks, meaning everyone who's left owns a slightly bigger slice of the pie.
Now, we are not talking about small potatoes here. The scale is just staggering. I mean, think about it. In some recent years, the biggest companies in the S&P 500 have poured more than 90% of their entire net income into buybacks and dividends. This isn't just some side gig for them. For a lot of these giants, it has become the main event.
Right, so that leads to the big question. How did we even get here? How did this thing, buybacks, grow into this absolute behemoth of corporate finance? Well, to understand that, we first need to look at the different ways a company can actually pull it off. So companies have a few different plays in their playbook for this. The most common one is just buying on the open market. They just, go out and buy their shares bit by bit, just like you or I would. But if they want to go big and fast, they can do something called a tender offer, where they publicly say, hey, we'll buy your shares for this premium price. They can also get fancy with a Dutch auction to figure out the lowest price shareholders are willing to sell for, or even cut a private deal with a huge investor to buy a massive chunk of stock all at once. Really, the method they choose tells you a lot about how badly and how quickly they want to get those shares back.
All right, let's get into the why. Why would a company spend billions buying its own stock instead of, building a new factory or investing in R&D or giving everyone a raise? Let's look at the case for buybacks.
Okay, the biggest reason by far, it all comes down to one word: flexibility. Think of it this way. A dividend is like a marriage. Once you commit, cutting it is a really big, painful deal. The market absolutely hates it. A buyback, on the other hand, is more like dating. You can ramp it up, you can slow it down, you can stop it entirely, and nobody really panics. That flexibility is golden for a company that has a temporary pile of cash but doesn't want to make a promise for life. Then there's the magic trick for a metric that Wall Street is absolutely obsessed with: earnings per share, or EPS. The math is super simple, right? It's just the company's total profit divided by the number of shares out there. So, what happens when you reduce the number of shares? That's right, the EPS number goes up, even if the company didn't make a single extra dollar in profit. It's a bit of financial engineering that can make the results look a whole lot better.
And it's not just about the math. A buyback is a huge signal. It's management basically shouting from the rooftops, hey world, we think our stock is a bargain and it's the best place for us to put our money. It also does some important housekeeping. You know all those stock options that employees get? Well, that creates new shares. Buybacks help soak those up so that existing investors don't see their piece of the company get smaller. And last but not least, there are the taxes. And oh boy, this is a big one.
Okay, just look at this for a second. The tax angle is a huge, huge reason why buybacks are so popular. If a company pays you a dividend, bam, you get a tax bill right away. But with a buyback, your stock value might go up, but you don't owe a penny in tax until you decide to sell, which could be years down the road. And check this out, for international investors, it's even better. They get hit with a big withholding tax on dividends, but on the gains from a buyback, often nothing. This isn't some minor loophole. It's a giant, flashing neon sign pointing companies toward buybacks.
So you add it all up, the flexibility, the EPS boost, the tax savings, and it seems like a total no-brainer, right? An efficient, smart, shareholder-friendly move. A win-win. But this is where the story takes a very sharp turn, because for every argument for buybacks, there's an equally passionate one against.
So now, let's flip the coin and look at the case against buybacks. Why do so many people see this as a huge problem?
This quote right here really nails the core criticism: prioritizing Wall Street over Main Street. The argument is that buybacks have become a way to juice the stock price for short-term gains, benefiting investors and executives, while starving the actual business, the Main Street part, of the cash it needs for things like R&D, new equipment, and paying its workers more.
Okay, so the criticisms really boil down to three big things. First, short-termism.
The accusation is that CEOs are chasing a quick stock price bump instead of making the tough, long-term investments that build a company's future. Second, it makes companies fragile. Get this, some companies actually go into debt to buy back their own stock. That's fine when times are good, but when a recession hits, they're left with a mountain of debt and no cash cushion. And third, and this is a big one, is inequality. Who owns most of the stock? Wealthy individuals and institutions. So buybacks effectively act as a giant wealth transfer mechanism, sending corporate profits straight to the top and making the wealth gap even wider.
Now, don't think for a second this is just a U.S. debate. This is going global. And what's really fascinating is seeing how different parts of the world are starting to deal with it. What you're seeing here is something of a quiet revolution. For a long time, buybacks were a very American thing. But look at Europe and Japan. They are jumping on the bandwagon, and fast. Why? Because companies all over the world are feeling the same pressure to be capital efficient and deliver those shareholder returns. It's a trend that's spreading like wildfire.
And this is where it gets really interesting because the rules are totally different depending on where you are. In the US, companies basically just give you a summary of their buybacks every few months. But in Europe, oh no. They have to report the details of every single trade, pretty much as it happens. That's a huge difference in philosophy. It really gets to the heart of the transparency debate and the suspicion that maybe, just maybe, some companies are timing their buybacks to prop up their stock price at convenient moments.
Okay, let's zoom way out for a second and think about the big picture. When you have trillions of dollars being spent on buybacks year after year after year, something strange starts to happen. It's called de-equitization. Basically, established companies are sucking shares out of the market faster than new companies are putting them in. The total pool of public stocks is actually shrinking. And basic supply and demand tells you that when supply shrinks and demand stays high, prices tend to rise. This could be a huge, almost invisible force pushing the entire stock market up. So that's where we land, with this one massive trillion-dollar question. Are buybacks a brilliant, efficient tool for modern capitalism? A smart way to return cash to the people who own the company? Or are they a short-sighted addiction that enriches executives, increases risk, and starves the real economy of investment? The truth is, it's a debate about the very purpose of a corporation today, and the answer isn't simple.